The biggest question surrounding people's minds in these days is when is the next recession taking place? Therefore, I am here today to analyze the three main indicators that may help you to identify when the next recession will take place in order for you to preserve your capital. First, hit the subscribe button and the alert icon to stay tuned with our most recent videos, and also join our newly launched Student Investor Forum and Members platform using the link below. The three main indicators are two previously mentioned topics. The first one is the US-China trade war, and the second one are the interest rates, and the third one is something called the inverted yield curve. First of all, the US-China trade war. After the G20 summit, there was a 90-day period for the tariffs not to be increased, as they were looking for a solution between the two sides. And then 1st of March was the deadline to come to an agreement or raise the tariffs even more. However, the tariffs were not raised in March. However, there was no solution. Both sides promised that there has been a great progress between the talks, and for example, in topics like intellectual property rights and technology, which is a main issue in the US-China trade war. And there is an expected resolution in this month, in April, or some analysts are saying that it will be delayed again by June. But the positive thing is that there are no more tariffs, and also the US started talks with European officials also to try to decrease trade tariffs. These indicate a positive outcome towards the worldwide trade situation, and that is why the markets take it positive at the moment. However, if these so-called promises are found false, and they're just trying to calm down the markets, and there is no resolution in the end, then the markets will turn into bear market territory. Secondly, regarding the interest rates, the Fed was supposed to raise the interest rates in 2019 and also in 2020. However, the Fed decided not to raise the interest rates in 2019, as they have noticed that the economy will experience a slow growth. These two aspects contradict each other, as the pause of interest rates is something that investors usually take positively, as companies will be able to loan money with a lower interest rate. However, the Fed indicated a slow economic growth for the 2019 and also for the following years. Therefore, investors took that as a negative sign. However, this is just a short-term effect because companies are still growing, but not in the same pace as before. Therefore, in my opinion, as a long-term effect, it will not affect that much because there's still growth. It's not like there will be a negative growth. The third point is the inverted yield curve. The inverted yield curve occurs when the yield on the long-term bond, let's say a 10-year bond, is lower than the short-term bond, let's say a 2-year bond. My favorite inverted yield curve chart to follow is the 10-year and 2-year chart from Guru Focus. This chart presents also the previous recessions, the 7 previous recessions, and also how long after the crisis occurred. And the 7 past recessions occurred about a year and a half or 2 years after the inversion has occurred. Let's take an example of the 2008 financial crisis. The inversion happened approximately 2 years before the crisis, and the market, from the moment that the inversion happened, experienced about a 20% growth. By the market, I mean the S&P 500. To summarize, the first thing I would say is that you have to keep updated with the main news regarding the US-China trade war to see signs of progress or signs that the so-called positive talks have turned into negative, or they're just trying to delay the negative outcome, and therefore you'll see if the outcome is negative, then you should protect your positions, or if it's continuing, you should hold your positions if the talks are positive and it's close to a resolution. Regarding interest rates, so far there are no hikes for 2019. Let's see what they say for 2020. Even if they say that there will be a hike in 2020, it won't be such a big thing in the long term. Therefore, I believe even with a slowing economy, the economy is still growing, and therefore that doesn't affect your investments so much. However, regarding the inverted yield curve, I would say that you're safe for another year and a half based on historical data, and then you should consider turning into safer investments, for example, gold. However, there were times, let's say in 1995, that the inversion almost happened, but then the recession happened in the year 2000. It was just a sign, but it didn't happen. So sometimes there is a false indicator. However, I would say that the past recession happened 10 years ago, and therefore the financial crisis should occur soon, and therefore I would say for another year and a half we could expect a good growth in the stock market if the U.S.-China trade war comes in a positive outcome, and then you should worry about maybe closing some of your positions and turning into safer investments, as I said. Thank you very much for your attention. And if you would like to learn a straightforward, efficient, and effective way of investing your capital or creating a successful business plan, access the Student Investor Guidebook or Business Plan Example using the links below.